Imagine this, you're sitting on a goldmine of stocks picks and you don't even know it yet. Today we're diving into Tom Lee's new stocks to buy now in July 2024. These high growth stocks could be the game changer for your portfolio, but there is a twist and you won't see it coming. Meet Winston, my adopted golden retriever, and believe it or not, my secret weapon in stock research. He sniffed out some incredible insights here that we're about to share. And Winston has also just been awarded a Best Dog in a Supporting Role Oscar. So my goddaughter gave this to me. So he must be onto something here for sure. Our teaching portfolio is also up over 80% this year, and that's entirely Winston's doing. He's managed to gain $24,000 on a 30K portfolio, turning $30,000 into $54,000 in a space of just 7 months. If you want to know how he does that, then come and join our live trading session on Wednesday at felixprehn.org/webinar. Grab yourself one of the last free spots available. All right, let's get into the first stock on Tom Lee's list. But remember, the best is yet to come, so stick around. First up, Amgen Inc., ticker symbol AMGN. This biotech giant is a leader in the industry focusing on innovative therapies for serious illnesses. And here's what we're somewhat excited about. Their recent breakthrough in oncology treatments are promising, and their robust pipeline suggests strong future growth. With potential rate cuts on the horizon, biotech companies like Amgen could benefit from lower borrowing costs and higher multiples that the market allows for these high-risk stocks. However, one key risk is just the volatility of the biotech sector. My first investment in 1999 was biotech, so I'm still a little bit PTSD'd by the whole experience. So one failed clinical trial and the whole thing blows up. So be a little bit careful with this one. But as I say, it is the first on this list, so let's dig a little deeper. Well, Winston says he's quite excited about it, so Winston seems somewhat excited about this one, so let's dive a little bit deeper into AMGN and why it is on Tom Lee's must-watch list. Amgen's revenue has been growing steadily with a 5-year compound annual growth rate of 6%. Not exactly massively exciting, but most of these companies have no revenue whatsoever, and the recent FDA approval of their new cancer drug is a significant milestone. But as I said, the market is competitive, so you want to keep an eye on how their products perform against established treatments. So let's move on to Tom Lee's gem number 2. This is a little bit of a bigger company. It is Colgate-Palmolive, ticker symbol CL, known for their household and personal care products. CL has been a staple in many homes. I would probably put $5 on it that you have at least one Colgate-Palmolive product in your kitchen or bathroom. So what is the excitement about this? Well, strong brand, market presence, so it's a reliable choice. And with potential rate cuts, consumer goods companies like CL could benefit from lower interest rates, which means more consumer spending. It could reduce borrowing costs for expansion. But there is a risk with these guys also. There's a risk with pretty much everything, and that is competition. The consumer goods sector is getting more competitive, but Colgate is probably pretty well positioned to gobble up and absorb most competitors that they don't like the look at. So let's take a little bit of a closer look at CL's market position and the challenges here. Their market share has been very stable, but their growth has been a little bit sluggish. The company is very, very reliant on its oral care segment, Colgate, right? Which is facing stiff competitions from both established players and new entrants, all the weird and wonderful, cinnamon flavored, made from tree bark type toothpaste. They are taking market share. I have tried a lot of them. I've never really been convinced, honestly. I like the lack of chemicals and, attempts to poison me, but the question is, do they really work? But anyway, there's a lot of people out there who don't necessarily want to buy Colgate stuff nowadays. But Winston's got a pretty good feeling about it. He doesn't brush his teeth. We give him seaweed. Seriously. If you ever have a dog with bad teeth, give him seaweed. It's amazing. Message me if you want to know how that works. You can go on Amazon and buy literally seaweed. You can buy it for dogs as a powder, or you can just buy general seaweed. Now, stock number 3, this gets a little bit more exciting, is Emerson Electric. Ticker symbol is EMR. And EMR is a powerhouse in the industrial automation sector. And you're like, Felix, can you not give me some AI stocks? Well, this is Tom Lee's list, not mine. But the rise of smart manufacturing, EMR's advanced automation solutions are in higher demand. And their recent acquisition of a leading software company is a move that broadens their capabilities to be more than just a manufacturing company, but more of a digital transformation company. So again, rate cuts could mean industrial companies like EMR will benefit from lower borrowing costs, as do their customers, making it easier to finance large capital projects and acquisitions. And they could benefit significantly from the whole robotics thing, right? If all manufacturing has to upgrade, then these guys will probably do quite well over that. So what was that acquisition I just mentioned? I'm generally not a big fan of M&A. Most of the time, the company that buys another company pays too much for it, and it's harder to integrate than they thought. But Emerson's acquisition here was Aspen Tech, a leader in industrial software. And that is actually a game changer. It's a move that not only expands their product portfolio, but it also enhances their capabilities. So it makes their existing product better. And therefore, I'm quite happy about this expansion of EMR sector and capabilities, and therefore might make the being on the list of Tom Lee here a little bit more logical. So Winston's got a good feeling about it, but let's keep the momentum going here. And the next ticker is Ingersoll Rand. I'm sorry, who? Yes, IR is the ticker symbol. It's another industrial giant. So what's with all the industrial stuff? Look at a stock chart of the industrial sector. And I'll try to put one on the screen here for you if I remember. And industrial company stocks have done very, very poorly. Manufacturing has been in an unacknowledged recession, and no one's been investing. Why? Because interest rates have been sky high, and companies don't invest in manufacturing kit when it's hard to finance it. So you would expect the whole industrial sector to recover simply with falling interest rates. Now, these guys focus on climate solutions and industrial tech, which has actually driven pretty impressive growth for them. Again, as I said, potential rate cuts could make this company worth more. It could make their customers want to buy more, and so on. So Winston, again, has a pretty good feeling about it. He seems to like Tom Lee. But let's explore the growth strategy of IR here. What are the market opportunities? Their margins have been under pressure a little bit due to rising input costs, competitive pricing, and that's not really what you want to hear, right? But ultimately, I think the whole play relies purely on rate cuts. So I think a lot of Tom Lee's late picks are purely rate cut picks. So he's just saying rates are going to come down, we all expect it, and therefore these kind of companies, industrials, financials, small caps, should outperform. Stock number 5, hopefully the most exciting of Tom Lee's lot, is Leidos Holdings. Ticker symbol LDOS. Maybe it's pronounced Leidos. I'm not quite sure. It's spelled LEIDOS Holdings. It's a leader in defense, aviation, and IT services. So why is Tom Lee excited about it? Well, they've got pretty significant expertise in cybersecurity, advanced analytics, which is crucial today. And again, potential rate cuts could see defense and IT sectors benefit from more investment. However, this is kind of a semi-government company. I mean, they're relying a heck of a lot on government contracts, which can be quite unpredictable. Now, depending on which way you think the wind's going to blow, if Trump gets in, you might see more investments in the sort of more high-tech defense sector and a little bit less on bullets, which is what they're currently spending most of their money on. And therefore, these kind of companies could benefit from that. So I kind of get it. Sounds a little bit sort of, the kind of Palantir rationale a little bit there. We're expecting more government expenditure on that. And they have secured several high-profile government contracts. There's a recent $1 billion contract for cybersecurity services. But government contracts come, as the wind blows. It's a little hard to predict them. So you need a bit of a longer time horizon here on this one, I feel. There is another stock here, which is the S&P Global, ticker symbol SPGI. And I like this one. I like this one a lot. I actually own this one. And it is basically financial information analytics. It is literally all about the S&P 500. But they don't just do that. They sell a lot of data. So their data and insights are invaluable to investors worldwide. S&P Global also bought a company lately called IHS Markit, which has significantly expanded their data and their analytics capabilities, which we quite like. And it's just a name that is so ingrained with the world of finance that their customers are pretty sticky. They're always going to buy data and research from the S&P. And yet there are startups and so on around there. But these kind of companies like your Bloombergs and your S&P and your MSCI, I think have a very, very strong moat. Their customers are just, as I said, very, very sticky. So it's a pretty decent business. And it's small enough to benefit from falling interest rates, as money might move a little bit out of the largest cap stocks and look more for value down the chain. And the S&P certainly provides value, in my humble opinion. Now, the next stock here on the list is a company I didn't really know much about. It's called Vertex Pharmaceuticals, ticker symbol VRTX. And it's another biotech company. They specialize in the treatment for serious diseases again. But what is exciting about this one? Well, they do groundbreaking work on cystic fibrosis. And that has been in the headlines quite a lot. And again, with potential rate cuts, biotech companies like Vertex could benefit significantly because we just look for higher risk when rates go lower. There is more money coming out of all the money market funds, out of all the bond funds, and it's looking for higher returns. So it's a little bit more of an aggressive time period when rates come down, and therefore these sort of companies could benefit significantly. Finally, let's talk about the last stock on the list here, definitely not the least. It is Williams Companies, ticker symbol WMB. It's a leader in energy infrastructure, and I quite like this. Here's what Tom Lee is excited about. They're focusing on natural gas and renewable energy solutions, which positions them pretty well for a likely resurgence in energy. Have a look at a stock chart of the energy sector. It's been a pretty depressing time period. We're likely, with falling interest rates and a potential Trump presidency, going to see a lot more investment in US oil and gas and renewables and just energy security. And companies like WMB could benefit from that as sort of a shovel for the whole sector. So rather than buying an oil or gas major, I think this could be a smarter play. Williams Company has an extensive pipeline network and essentially focus on natural gas. So it makes them a key player in the energy sector. And while there is always volatility in the energy sector, there are moments when everybody hates it. And I think it's in moments like that you might want to start looking at it. At the moment, I quite like energy for that reason. If you have a little bit of a contrarian in you, a little bit of a longer horizon, WMB might be something you want to dig a little bit deeper into. Now, remember, Winston's nose for trading. His teaching portfolio is up 80% so far this year. That's $24,000 gain on a $30,000 portfolio. If you want to know how he does that, and he's not promising you results, but he's promising to be generous and teach you the whole system and structure for free, come and join us on Wednesday. We'll teach you for free, felixprehn.org/webinar. The link is down below in the description. And if you enjoyed this video, share it with a friend. You might get some value out of it, and I wish you amazing success. Winston and Felix here, and today we're going to dive into some high growth stocks that could potentially skyrocket your portfolio. But hold on, because there is a twist to this story. And yes, Winston here, my adopted golden retriever, has sniffed out some incredible research for us. So let's get cracking. Now, you might be thinking, what's the